Welcome to the discussion of accounting rules and principles of the Business Fundamentals class. Today, our lecture topics are assumptions, principles, constraints, and bodies that govern accounting. Accounting assumptions. The first assumption that we make when we are producing financial statements for a company and when we are reading financial statements of a company, the first assumption is what's known as the economic entity assumption. We assume that the financial statements are produced for an entity separate from other entities and separate from its owners. The second is known as going concern. Financial statements are produced as if the company will continue in existence for the foreseeable future. It is practical because let's say a company is going to go out of business and they have to liquidate their assets. You can imagine that the value of their assets would be much less than if it were a going concern. You think when you see a furniture store going out of business, they're selling their inventory at even below cost. So that's the going concern assumption. Another assumption is the monetary unit assumption. It's the idea that we can express value in terms of currency and that the currency that we're expressing values in is relatively stable. In the United States, our financial statements are produced in dollars. Time period assumption means that we can break up time into these artificial periods such as months, years, quarters, and report in a logical fashion using those time periods. Accounting principles. The first accounting principle is the cost principle. We record transactions that happen at their cost. So think, I bought a building for $500,000, but I think it's worth $550,000. What a deal I got. I cannot put the building on the books at the value of $550,000. I have to put it on the books for what I paid for it. That is known as the cost principle. You may also hear the historical cost principle. The next is revenue recognition. Revenue recognition forms the basis for accrual-based accounting. What is accrual-based accounting? Well, accrual-based accounting is that we don't necessarily recognize income or sales and expenses when we write the check or when we pay for them. We recognize these things when they happen. So for revenue recognition, we recognize income when we earn it. Sometimes an accountant or a lawyer will have their clients pay them a fee at the beginning of the year. It's called a retainer. So customer or the client will give you a retainer, maybe $10,000 or something, to reserve your time for the year. What happens under those circumstances is that you can't recognize that as a sale yet until you actually provide the service. If you think about it, you owe the services, so that would be a liability. Okay? Revenue recognition. Recognize the revenue when it is earned and also when payment is reasonably assured. The next principle is the matching principle. Under the matching principle, we recognize expenses when they happen, not necessarily when we pay for them. A good example is the light bill. You get an electric bill. You get the electric bill in May for April. You recognize the expense in April because that's when you used the electricity. Finally, there's the full disclosure principle. Under the full disclosure principle, accountants should disclose as much information as possible in the financial statements so that decision makers can rely upon that information. There are some constraints on following these principles. And the first constraint, or the first thing that might hold us back, is something called the cost-benefit constraint. You always have to be aware that the cost of producing information should be less than the benefit. Benefit should exceed the cost. There's also something called materiality, which is closely related to the cost-benefit constraint. What materiality is, if something is material to a decision maker, it means that it makes a difference in a decision. So if something is immaterial, if it wouldn't make a difference in a decision, then we don't have to record it. And finally, there's something called conservatism. The conservatism constraint tells us that if there are two things that are equally likely to happen, we need to choose the one that is the least beneficial to report. Because remember that people like creditors and investors are making decisions about what to do with their money, and we don't want to be misleading or deceiving. So there's something called a contingency. A contingency is something that might happen because something else happens. An example of a contingency is a lawsuit. So if you're being sued and you think that you will have to settle that lawsuit, even though the lawsuit hasn't been settled yet, even though the court hasn't made a decision, you still have to put it in your financial statements as something that you owe if you think it's likely. That's an illustration of the principle of conservatism. Next, we will discuss the governing bodies. These are the organizations that are responsible for creating accounting rules. The first one we will discuss is the FASB, the Financial Accounting Standards Board. The FASB creates rules that we follow here in the United States. The IASB, the International Accounting Standards Board. That organization creates rules and regulations internationally. Both of these organizations are nonprofit organizations that get their right to make up rules from their respective governments or from different governments. In the United States, the organization that is responsible ultimately for accounting rules is the SEC, the Securities and Exchange Commission. The Securities and Exchange Commission has designated FASB to be the organization that gets to make the rules in the United States. That said, the SEC has created the Public Companies Accounting Oversight Board, PCAOB. That board is responsible for making up rules and regulations for firms that audit public companies. So the Securities and Exchange Commission is the organization that has the legal responsibility to create accounting rules in the United States. It has allowed the FASB to create rules. FASB is a nonprofit organization. The IASB is the international body. That body is trying to make rules and regulations that everybody follows because of the expansion of global markets and global economies. The idea that a company in China or Britain or Egypt would follow the same rules as one in the United States would make it a lot easier for investors and creditors to make decisions about financial statements. So far, the FASB and the IASB have not converged, but the Securities and Exchange Commission has said that it would like the United States to begin to follow international rules. So that's something that we need to follow very closely. I wanted to provide you with some links to some of these organizations. The first one is the Securities and Exchange Commission. The next one is the Financial Accounting Standards Board. I've also provided you with a link to the Public Companies Accounting Oversight Board. And finally, the IFRS, which is known as International Financial Reporting Standards. IFRS shares a website with the International Accounting Standards Board, and the IFRS are actually the rules that the IASB has promulgated. If you have any questions or concerns, don't hesitate to send me an email, shoot me a text, send me a message online. Talk to you soon. Thanks for listening.